Welcome to Smart Tech and Finance. Today, we unlock the ultimate secrets of Japanese candlestick patterns for professional trading success. Mastering these visual market indicators will completely transform your trading journey, allowing you to predict major market reversals with. We're diving deep into the essential reversal patterns every pro trader must know to survive and thrive in financial markets. Have you ever wondered how top traders catch market bottoms and tops? The secret lies entirely within these ancient Japanese charts. Before risking your valuable trading capital, you must thoroughly understand the hidden psychological battles displayed through every single candle. Let us begin by breaking down the fundamental anatomy of a standard Japanese candlestick, starting with its solid central rectangular body. The thick body represents the crucial difference between the opening and closing prices during a specific time frame in the trading session. Meanwhile, the thin lines extending above and below the body, known as wicks or shadows, indicate the extreme price fluctuations reached. Long upper wicks show intense selling pressure, while long lower wicks reveal aggressive buying power stepping in to support the asset. Understanding this dynamic tug-of-war between buyers and sellers is the absolute foundation of all successful technical analysis and trade. Now, let us explore the most powerful single reversal patterns, starting with the legendary pin bar, also known as the hammer. A hammer candlestick features a small body at the top and a long lower wick, indicating a massive rejection of lower prices. When this specific pattern appears after a prolonged downtrend, it strongly signals that buyers have finally regained control of the market. Conversely, the shooting star is the exact bearish equivalent, appearing at the very peak of a strong upward market price rally. The shooting star has a small lower body and an extremely long upper wick, showing that aggressive sellers overwhelmed the buyers. If you spot a shooting star at a major resistance level, prepare for a potential downward reversal in the upcoming sessions. Next, we must examine the inverted hammer, which looks exactly like a shooting star, but critically appears at the market bottom. The inverted hammer shows that buyers attempted to push prices higher, signaling early bullish momentum despite the temporary intraday selling pressure. On the other hand, the hanging man pattern mirrors the hammer shape, but ominously forms at the top of an uptrend. The hanging man warns traders that selling pressure is quietly building, often foreshadowing a sudden and violent drop in asset prices. Single candlestick patterns are incredibly useful, but combining multiple candles provides much stronger confirmation for your critical trading and investment decisions. Let us transition into powerful dual candlestick formations, beginning with the highly reliable and widely used bullish engulfing reversal. In a bullish engulfing setup, a small red bearish candle is completely swallowed by a massive green bullish candle immediately following. This dramatic visual shift proves that buying volume has entirely overwhelmed the sellers, heavily suggesting a strong upward trend. Alternatively, the bearish engulfing pattern occurs when a large red candle completely covers the preceding small green candle at a peak. When you witness a bearish engulfing pattern, it is usually a very smart time to consider taking profits and exiting longs. Another fascinating dual formation is the inside bar, also affectionately known by veteran Japanese traders as the traditional harami. The inside bar features a smaller candle, completely contained within the high and low range of the previous massive mother candle. This specific formation represents a sudden pause in market momentum, indicating deep indecision before a potential explosive breakout in a bullish harami at the bottom of a downtrend, suggests the heavy selling pressure has finally exhausted itself completely and thoroughly. Moving forward, we will analyze triple candlestick patterns, which offer the highest probability of success due to their extended confirmation. The morning star is a beautiful three-candle bullish reversal pattern that typically marks the absolute bottom of a brutal market crash. It begins with a long red candle, followed by a tiny indecision candle, and concludes with a massive green explosive. The morning star perfectly illustrates a complete psychological shift from total panic selling to renewed hope and aggressive buying volume. Its sinister twin is the evening star, a three-candle bearish reversal pattern signaling the tragic end of a joyful. The evening star starts with a strong green candle, stalls with a small star, and violently crashes with a huge red candle. Recognizing these specific patterns is only the first step. The real secret lies in knowing exactly where they appear on chart. A common mistake amateur traders make is trading these reversal patterns randomly in the middle of nowhere without any structural context. Reversal candlesticks only possess true predictive power when they form at significant market structures like major support or heavy. If you see a beautiful hammer candle floating aimlessly in a sideways consolidation phase, you should absolutely ignore it and wait. However, if that exact same hammer forms perfectly at a historical daily support level, it becomes a highly profitable trading opportunity. Context is king in the trading world. Always combine your candlestick knowledge with solid trend lines, moving averages, and key Fibonacci. Let us discuss practical trading strategies, focusing specifically on how to enter the market safely when you spot these reversal patterns. For a bullish engulfing pattern at support, you should place your buy order just above the high of the engulfing candle. This entry method ensures that the upward momentum is genuinely confirmed before you risk your precious capital in the live market. Conversely, for a bearish pin bar at resistance, place your sell order slightly below the low of the rejection wick candle. Entering a trade without a protective stop loss is financial suicide. You must always protect your account from sudden market manipulation. The golden rule of stop loss placement for reversal patterns is setting it safely beyond the extreme wick of the formation. For a bullish hammer trade, your stop loss must be positioned slightly below the absolute bottom tip of the lower wick. This strategic placement guarantees that if the pattern fails and the market breaks lower, you exit with a very minimal financial loss. When trading the Morningstar pattern, place your protective stop loss strictly below the lowest point of the middle indecision candle. Calculating your risk-to-reward ratio is crucial. Always aim for trades that offer at least double your potential risk amount. If your stop loss requires risking $100, your target profit must be set at $200 or higher. Professional traders do not win every single trade, but their strict risk management ensures they remain highly profitable over the long. Let us review everything we have covered today about mastering Japanese candlestick patterns for achieving consistent and long-term trading success. You now understand the basic anatomy of candles, recognizing how the wicks and bodies reveal the secret psychological battles of traders. We explored the power of single candle patterns like the hammer and shooting star for identifying immediate and aggressive price rejection. We analyzed dual patterns like the engulfing and inside bar, which provide stronger confirmation of shifting momentum in the financial. We then uncovered the heavy predictive capabilities of triple patterns like the Morningstar and Evening Star for major trend reversal. Most importantly, you learned that these patterns are completely useless unless they appear at critical support and resistance zones on charts. We established strict rules for entering trades and placing stop losses to protect your capital from unexpected and violent market volatility. Trading is a game of probabilities, and combining candlestick patterns with key market structures drastically shifts the odds in your favor. To truly master these concepts, you must spend countless hours backtesting these specific patterns on historical charts before open your trading platform today. Scroll back through the past year of price action and manually identify every single reversal pattern. Observe how the market reacted when an evening star formed at major resistance versus when it formed randomly in a channel. Keep a detailed trading journal documenting every setup you find, noting the context, the entry point, and the final trade outcome. Over time, your brain will naturally recognize these profitable formations in real time, allowing you to execute trades with absolute. Remember that emotional discipline is just as important as technical analysis. Never revenge trade if a perfect candlestick pattern. The market is always right, so respect your stop loss, accept the small loss gracefully, and patiently wait for another opportunity. As you continue your journey to becoming a pro trader, keep refining your strategy and adapting to ever-changing market conditions. Stay tuned for our next advanced lesson, where we will combine these candlestick patterns with powerful volume analysis and momentum indicator. By layering multiple technical concepts together, you will eventually build an unstoppable and highly profitable trading system for your. Thank you for watching this comprehensive guide on Japanese candlestick patterns and technical analysis for modern financial markets and crypto. If you found this valuable, please like, subscribe, and share this video with fellow traders looking to improve their market edge. This is Smart Tech and Finance, wishing you highly successful trades, massive profits, and a wonderful journey ahead. See you soon!